Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Qualys Inc. Annual Report. Qualys Inc. offers a wide range of businesses and services through its cloud-based platform. The company's solutions include cybersecurity asset management, external attack surface management, vulnerability management, detection and response, web application scanning, patch management, custom assessment and remediation, multi-vector endpoint detection and response, policy compliance, file integrity monitoring, and Qualys Total Cloud. In addition to these services, the company also provides cloud workload protection, cloud detection and response, cloud security posture management, infrastructure as code, SaaS security posture management, Kubernetes, and container security. These solutions enable customers to identify and manage IT and operational technology assets, collect and analyze IT security data, discover and prioritize vulnerabilities, quantify cyber risk exposure, recommend and implement remediation actions, and verify the implementation of such actions. The company's Enterprise True Risk Platform is an integrated suite of IT, security, and compliance solutions that provide asset tagging and management, reporting and dashboards, questionnaires and collaboration, remediation and workflow, big data correlation and analytics engine, and alerts and notifications. These services are offered to enterprises, government entities, and small and medium-sized businesses in various industries through the company's sales teams and network of channel partners, including security consulting organizations, managed service providers, resellers, cloud providers, and consulting firms. Qualys Inc. stock has experienced a significant drop of over 31% in the past year due to several key news events. One major contributor was the company's weak financial guidance for 2026, which indicated slowing growth and missed analyst estimates. This led analysts from J.P. Morgan and Scotiabank to lower their price targets for Qualys. Another factor was investor fears regarding the disruptive potential of artificial intelligence, AI, in the cybersecurity sector. Concerns persist that AI could commoditize vulnerability management, reducing Qualys' pricing power and competitive edge. These concerns were further fueled by insider stock sales, including a significant sale by CFO Joo-mi Kim on February 4, 2026. Additionally, sector rotation played a role as investors shifted their focus to other technology stocks performing well, despite Qualys reporting strong fourth-quarter 2025 earnings that surpassed Wall Street expectations. The overall sentiment suggests ongoing risks for Qualys, including the potential integration of AI-based security features by major providers like Microsoft, Amazon, or Palo Alto, which could weaken the need for specialized vulnerability management tools and erode Qualys' pricing power. Qualys Inc. maintains a market capitalization of $3 billion, broadly in line with the industry peer group. Qualys Inc. trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 5.9 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 51% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of financial statements. On the positive side, an increase in accounts receivable, deferred revenues, and revenue recognition are key indicators of revenue growth. Upsells and contract modifications also contribute to revenue expansion. Conversely, a decrease in deferred revenues and unrealized losses on marketable securities can lead to revenue decline. Geographic drivers play a significant role in revenue growth, with some regions experiencing higher growth rates than others. Currency exchange rate fluctuations and interest rate changes are also notable trends that can impact revenue growth or decline. To track performance over time, key performance indicators such as revenue growth rates and net income as a percentage of revenues should be closely monitored. In conclusion, understanding the drivers of revenue growth and decline is crucial for businesses to make informed decisions and adjust their strategies accordingly. By analyzing financial statements and identifying key trends, companies can capitalize on opportunities and mitigate risks associated with revenue fluctuations. The net income of the company experienced a mixed trend over the two-year period. Initially, it increased by 14.4% from 2023 to 2024, indicating a positive growth trajectory. However, this upward momentum was short-lived, as the net income decreased by 14.2% from 2024 to 2025. A closer examination of the profit margins reveals a decline in gross profit margin by 1.5% and operating income by 15% from 2025 to 2024. This significant drop in profitability can be attributed to various factors, including fluctuations in operating results, failure to meet expectations, and negative impact on margins from shortfalls in revenues. The reasons behind these changes are multifaceted. Competitive pricing pressures, currency fluctuations, potential false positives, and incorrect detection of vulnerabilities have all contributed to the decline in gross profits. These external factors have had a profound impact on the company's bottom line, resulting in decreased profitability and net income. The company's financial performance indicates a positive trend in operating cash flow. According to page 51, the company has been generating positive operating cash flow. This is further confirmed by page 61, which shows net cash provided by operating activities for all 3 years from 2023 to 2025. Although page 64 provides different figures due to an adjustment for credit losses, it still supports the overall conclusion that the company is producing a positive operating cash flow. The company's debt level has experienced a mixed trend in recent years. Initially, it increased significantly by $37,507 from 2024 to 2025, as reported on page 57. However, this increase was short-lived, as the debt level decreased by a mere 0.12% from $378,952 to $379,458, as stated on page 72. Regarding interest expenses, there is some confusion due to conflicting information across different pages. On one hand, the accrual of discount on marketable securities changed from -$6,735 in 2024 to -$3,440 in 2025, indicating a decrease in interest income. On the other hand, interest expense is not explicitly stated on page 99, where it is reported that interest income decreased from $25,784 in 2024 to $25,251 in 2025. In summary, while there are some discrepancies in the data, it appears that the company's debt level has undergone a slight decrease, and its interest expenses have not been explicitly stated. The performance of various segments and regions within the company has been a mixed bag. On the positive side, both the direct segment and partner segment saw significant increases in revenue from 2023 to 2025, with growth rates of $23,010 and $91,657 respectively. In terms of regional performance, the United States region was relatively stable, with revenues derived from U.S. customers remaining steady at around 56–60% over the past 3 years. The Americas region also showed stability, with revenue percentages hovering between 43–49%. However, not all regions fared as well. International markets, which include Europe and Asia-Pacific, struggled due to expansion challenges, indicating a need for improvement in these areas. Additionally, while India has a significant employee presence, its performance is not explicitly mentioned in the summary. Overall, it appears that domestic segments and regions have been more successful than international ones, highlighting potential opportunities for growth and investment in emerging markets. Management is optimistic about the company's outlook, citing a large and growing opportunity for comprehensive cloud-based IT, security, and compliance solutions. The goal is to help customers prioritize cybersecurity threats and provide a unified view of cyber risk across an organization's entire attack surface. To achieve this, the company aims to strengthen its leadership position through innovation, expansion of existing customer use, targeted sales and marketing efforts, strategic partnerships, and technology acquisitions. The company acknowledges significant competition in the future, but believes its suite of solutions competes favorably with respect to key factors such as product functionality, breadth of offerings, and customer support. To drive growth, management plans to recruit and retain qualified sales personnel, invest in shared cloud platforms, customer support teams, research and development, sales and marketing efforts, and people. However, the company also faces significant risks, including managing international operations, which poses challenges due to corrupt business practices, improper sales arrangements, and cultural differences. Additionally, changes in sales tax laws and regulations may result in significant tax liabilities. Management emphasizes that actual operating results may differ significantly from its guidance, and it will retain future earnings for business development and expansion rather than declaring or paying cash dividends. The company's financial activities have been focused on strategic investments and returns to shareholders. One notable initiative is the authorized share repurchase program, which was established to purchase a significant number of shares from the market. In 2025, the company exercised this option by buying back 1.4 million shares for $182.9 million. This move demonstrates the company's commitment to maximizing shareholder value and returning profits to its investors. By reducing the outstanding share count, the company aims to increase earnings per share and enhance its overall financial performance. There are valid concerns about potential disruptions in the supply chain. One area of concern is the shared cloud platforms, which could experience service disruptions. Additionally, the loss of a major channel partner could have a significant impact on sales. Furthermore, extended sales cycles and trade barriers pose a threat to the smooth functioning of the supply chain, potentially leading to delays or shortages. These factors highlight the vulnerability of the current supply chain system. That concludes the financial summary for Qualys Inc. Feel free to comment below, and I will be happy to answer them when possible.